Hey everyone, welcome back to POA for You. It's Leroy again, and today we are gonna do an accounts payable question from a school exam. And this was given to me at the request of Kaimeng, so thank you very much, Kaimeng, for writing in. And today we'll attempt to see what this question brings us. Right. Okay, so we have a list of transactions in the month of February, and the first part of the question asks us to prepare Jordan's accounts in the books of Shen. So let's understand who is Jordan, who is Shen. Let's take a look at February 1. What's the first statement? Balance brought down for amount owing to Jordan was 4,007. So Shen owes Jordan 4,007. So in this case, Jordan is the accounts payable in Shen's point of view, right? In Shen's books. So when we talk about preparing an account, it's basically a ledger account, and this ledger account is in this format, right? So accounts payable is to Jordan, and the format has dates, particulars, debit, credit, and balance. Let's see how we use this, okay? Now the first part is we have to have the year, so we're going to put a year in 2020, and the first date is February 1st. So February 1st, it says balance brought down is of a certain amount, and 4,007. So balance brought down is 4,007 credit. What does this mean? Balance brought down means this is the balance as of the 1st of February. Shen owes Jordan 4,007, and this could be because of transactions that happened before February 1st. So for example, in the month of January, Shen bought from Jordan certain amount of goods on credit. So he bought the goods, but he hasn't paid. All right, and as of February, this remains unpaid, and therefore it's a balance brought down from previous months or years or whatever, and this amount is 4,007. Now this is credit, right? The accounts payable is credit in nature. It means that when we owe someone a certain amount of money, the balance is represented at the credit side of the ledger, and if the balance, how much you owe the person, goes up, then you would credit that account. How much you owe the person goes down, you would debit that account. And I'll show it to you in a bit, right? So February 4th, what happened? Shen bought goods on credit from Jordan worth 4,003, and he received a 10% discount at the same time when he bought it. Okay, so let's look at the double entry first. The double entry, let's move this here. The double entry in this period is debit inventory of 3,780 and credit accounts payable 3,780. Why do I get 3,780? The goods were worth 4,003, but he received a 10% discount. So right away, this has a 4,300 and minus 10%. So it becomes a 3,780. 3,870 was the purchase price of these goods. Now, debit inventory and credit accounts payables. Why? You debit inventory because you bought these goods. Shen bought these goods to sell, and these goods are called these goods are therefore called inventory when they are bought for the purpose of selling. And inventory is an asset account. When you got more of it, you debit the asset account. And he bought it on credit, which means when he bought it, he owes Jordan more. And accounts payable is credit in nature account. So when you owe somebody more, you credit into the accounts payable account. So I would move this 3,780 on the February 4th into this part here, 3,780. So you see I'm crediting the accounts payable account, and this is the accounts payable account. I'm crediting it for 3,780. In the particulars, I would take the other side of the double entry and put it in the particulars. So in this case, it's inventory. Okay, and then the balance is just 4,700 plus anything on the credit side, because it's an accounts payable account, it's credit in nature, so it becomes 8,570, and I will put a credit balance here. Okay, so that's February 4th. Now February 6th, bought goods on credit from Jordan worth $1,000. So no discount this time, it's just $1,000, so it's pretty straightforward. You just have to debit inventory again and credit accounts payable for $1,000 this time. So no discount. So let's see, it's pretty straightforward. It will be similar to what the double entries are on February 4th, and the entries are just, the numbers are different. Okay, that's about it. Now let's see what happens on let me just move this here. It's okay, I'll leave it here. Don't know whether you guys can see it later, but it doesn't matter. Okay, so February 8th, paid Jordan 4,007 using check. 4,000 using check. So when you pay Jordan an amount using a check, your accounts payable actually goes down. So as opposed to what we've been doing in the first two lines here, we have been accounts payable has been going up, right? The account. So now it's going down. So therefore you debit accounts payable and you credit what? Cash at bank, because you have paid you've paying Jordan using check. Your cash at bank balance will go down, and cash at bank balance is an asset account, and when asset goes down, you credit it. When it goes up, you debit it. Okay, so you credit cash at bank, and how much? $4,700. So how do you put this in the ledger? You put the date first, February 8th. You put the amount on the debit side because you debit accounts payable 4,007. So I put it in here. This particular, what do you put? You always put the name of the account on the other side of the double entry, and in this case the other side of the double entry is cash at bank, right? So I'm going to put cash at bank in here, and then the balance would be 9,750 minus 4,700, right? Because it's on the debit side and this is a credit nature account, and then the balance will be this amount and it's a credit balance. Now February 15, what happens? Okay, I'm going to move up a bit. February 15, we return $500 worth of goods to Jordan due to wrong specification. The goods were originally bought on February 4th. Okay, so February 4th, you must remember you had a 10% discount, yeah? So this $500, you already had a 10% discount, and this was the original price of the goods. So you got to bear in mind that whatever number that you put in the double entry has to be 500 times 10% discount, which is essentially 450. Okay, so what is the double entry here? So the double entry is when you return goods, your inventory, or when you buy goods, your inventory goes up, right? And your accounts payable goes up as well. So when you return goods, it's the opposite. So just put the opposite entry of when you buy goods, and the amount is 450, right? So 500. Remember to multiply by the 10% discount that you had on February 4th. So I'm going to put this here, February 15th. It's debit to accounts payable, so I'm going to put 450 here. And what do I put in the particulars? The other side of the double entry. In this case, it is inventory, and this will be the balance. Okay. Now let's see what's happening on February 20th. Jordan paid for goods that were bought on February 6th using check and received a 5% discount on top of what he owed. Okay, so he paid for goods that was bought on February 6th. Let's look at February 6th. He bought something for $1,000. Okay, so I'm going to say that the double entry is his accounts payable will go down because he paid for the goods, right? And it will go down, so it's a debit accounts payable, and it will go down by $1,000 because he's paid for all of it. Okay, but how did he pay, and how much did he actually pay? He paid through cash at bank, but he only paid, say, how much did he pay? He received a 5% discount, so he paid 1,000 less a 5% discount, which is 950. And there's a balance $50, right? On the credit side, what do I credit? I credit a discount receipt, and that's an account that will eventually flow into the statement of financial performance as an income. Okay, so how do I present this in the accounts payable? I'm just going to make it slightly smaller. So February 20th, I am going to accounts payable is going down by 1,000, and there are two entries on how it went down by 1,000. One is a 950 entry that is through cash and bank. So I'm going to put cash in bank here, and another is a 50 entry through discount received, which is in my double entry here. and this is my balance. I'll just roll the balance like I always do. 4,420 less 950 equals to this amount, and this amount less 50 is equals to this amount. Okay, so that is not all. To close a leisure account, you always have to do a balance brought forward to the next period, and the next period, which in this case will be the next month. So March 1st, and then you just do a balance brought down, and you just bring down the last balance here, right? And that's it for the first part. Okay, good. Now let's go to the next part of the question. State the types of discounts given on February 4th and explain why this type of discount is given. So February 4th, you bought goods, the list price, which is the original price, is 4,003, but you receive a 10% discount on this date. And the question asks, why do they give this type of discount, right? So what type of discount is it in the first place? It's called a trade discount. All right, trade discount is something when at the point when you're buying the goods, they give you a discount right away. Okay, and this is to encourage people to buy more, essentially, right? It's similar to how when we go shopping and we get a discount for buying stuff. The shopping malls and the retailers are asking us to buy more when we are at the point of buying. Okay, then state the source documents to record each type of transactions on February 4th and February 15th. So look at February 4th. This is when Xuan bought something from Jordan and got a discount, right? So what's the source document that is used to record this transaction? When you buy something, you would get an invoice from the seller. And when you sell something, you will give an invoice to the buyer as well. And this is to record the fact that you have actually put or send ship these goods over or given these goods to the buyers, and it's for a certain agreed price. So the invoice will tell you that. So the source document is an invoice. And February 15, return goods. So Xuan returned goods to Jordan, and when Xuan returns goods to Jordan, Jordan would issue Xuan an acknowledgement of the returns and saying that, okay, I've received the goods and now you owe me less. And the acknowledgement of that return is a credit note. Now, this is very important because this is always tested. I don't know, for some reason, examiners like to test the concept of credit note. So credit note is an opposite of invoice. Invoice tells you owe more, right? Normally from the seller to the buyer, and credit note is issued from the seller to the buyer saying that now you owe less because you have returned me something, because you've returned some goods that I've sold to you previously, or because the prices that I billed you before was too high, so now I'm giving you something lesser. All right. Okay, so that's it. I hope you enjoyed this video. If you have any questions, please feel free to let me know. Other than that, just share this with your friends. A free resource for everybody. All right, take care for now. Good luck. Bye-bye.